Hi, everyone. Welcome to the SAM webinar tonight. My name is Vanessa Ewan, and I am SAM's Director of Marketing, and I will be moderating the webinar today. I would now like to introduce SAM's Chief Investment Officer, Austin Root, and SAM's Deputy Chief Investment Officers, Michael Joseph and Mario Valente. Gentlemen, I will hand the presentation over to you and join you back during Q&A.
Thank you, Vanessa, and thank you all at home for joining us. Really excited about what we have to share with you tonight, and it's going to be a great night. So Matt McCall cannot join us, but in his place, he's been replaced not with one incredible investment guru, but two. That's right, as Vanessa just mentioned, the entire SAM Chief Investment Officer Brain Trust is here with you today. This is the first time we've ever done this all together. Michael Joseph, Mario Valente, and yours truly live. One night only. What do you guys think?
Long overdue.
I've got some butterflies, to be honest with you, Austin.
Yeah. So I'm excited. So we have a lot to cover. We've got a lot of. I have some prepared remarks and some prepared thoughts. Mario and Michael have some well thought out prepared remarks. But I thought, guys, we could go a little bit off script too. Kind of peel the curtain back, talk, maybe make this an investment committee session where we kind of talk about the world and, share with folks how we are trying to, first and foremost, protect our clients' wealth, but then, of course, and on topic, build generational wealth on behalf of our clients. So I don't know if you guys, does that sound good, guys? You have any other opening remarks?
Sounds like a great plan to me. It's a hugely important topic, obviously. So yeah, let's just jump into it, and Mario and I will, I'm sure, opine throughout the presentation here.
Sounds great.
Awesome, perfect. All right, well, with that, let's get rolling. Unlocking generational wealth. This is a roadmap for what we're doing. So look, how do we build? How do we generate and build generational wealth? Everyone wants to do it, but it can't be that easy, or else everyone would have done it, right, guys? So we want to start first with talking about what you shouldn't be doing, what not to do. Three points there, and then 4 points of what you must do. Steps that we believe, based on our many decades combined experience of being in the markets and investing in the markets on behalf of ourselves and our clients, things that you ought to be doing. We're going to hit a couple of hot topics. A lot of folks want to talk about artificial intelligence. Is it something to be feared? Is it something to get excited about? Is it a bunch of hot air? We'll talk about that. We have another topic that I want to hit. We'll be naming names with both of those. We'll be providing actionable investment ideas that we like quite a bit right now. Close with a little bit of summary, and then Vanessa hit on this, but this is truly live Q&A. So come at us with any questions. If it's a true clown question, I'm going to ask Vanessa to screen those. But otherwise, please ask us anything that you want to know about the world and particularly about this topic, but really about anything. And we're looking forward to answering and helping folks out. Okay, issue one. So what not to do? Point one, do not hide out in all cash. I think this is probably self-evident for folks, but we just have so many folks that are a little bit worried about the world. And I know all three of us have, in talking with clients and prospective clients, there's been quite a vacillation between being worried about everything and then being greedy about everything. And it's just challenging to have too much of your capital sitting on the sidelines. Why is that? Well, first off, it's this chart. The purchasing power of a dollar continues to decline. We know that the dollar is being devalued by continuous inflation, by proliferation of more and more dollars being printed. The other thing, though, is there's an opportunity cost to that dollar. Even if it did hold its value relative and there wasn't any inflation, you wouldn't be generating a big return on that dollar. So this is something, I guess, there is value to having dry powder, and we talk about that a lot. And in fact, I would say, guys, that we maybe at the margin across our strategies have a little bit more than average dry powder, because we want to be able to play offense when other folks are playing defense. But it can't be the preponderance of your investment base.
I think one interesting thing about that graph, Austin, is that the last time the dollar demonstrated significant strength was at the beginning of the Great Depression, right? So as you kind of see there in the late 20s or 1930, and then it had that big spike, and at the top of that spike, I think that's when President Roosevelt criminalized the possession of gold.
Yeah.
Ever since then, we've never seen any increase in the value of the dollar.
Absolutely. So we're off the gold standard, and that leads us perfectly into point 2, which is, while gold is a better store of value than cash money, do not buy only gold for your portfolio. Now, I know we tend to have for our clients folks that appreciate the value of gold and do want to have large stores of value, but again, it's not going to outperform productive assets over the very long term. It is what we just said, it will protect your value better than cash. It will do better than a dollar against inflation. But you really need to have productive assets like stocks and companies that generate a return on invested capital to outperform and to build generational wealth. And this chart kind of sums this up from since 1980, and gold has more than tripled, nearly quadrupled, from around 450 to $1,900 an ounce currently. But if you just bought this S&P 500 index, you would have done much, much better and compounded your wealth at a much higher clip. Thoughts on this, guys?
I think one other thing I'd like to add, well, at least to talk a little bit more favorably about gold here, Austin, is that, look, I mean, price of gold can certainly be influenced by factors like global economic conditions, geopolitical events, interest rates, investor sentiment. That's all well and good, but I think what I like about gold, at least partially for a part of portfolio, is that versus other non-equity asset classes like investment grade debt, high yield debt, corporate credit, for the last 30, 40 years, gold has done very well versus those non-equity asset classes too. So just to reiterate what Austin's saying, I think gold has a position, a prudent position in portfolios, but it should certainly not be the overwhelming factor in portfolios by any stretch.
Agreed. Well said. Okay, so don't do this number 3, and that is do not. So we're saying own productive assets, own these stocks of great businesses, but do not own just the world's largest companies. Those are yesterday's great stocks. This is a list of the largest companies in 1989. You can actually see it's dominated at that point by a number of Japanese banks and Japanese tech companies, or manufacturing companies. That list, the list of the 10 largest companies today, doesn't have a single one of the same companies. And in fact, had you owned that list of companies, you would have of the 10 from 1989, you would have materially underperformed the market. So I think that our main point here is it's just very tough for the world's largest businesses that have outperformed to get there to continue to outperform and build your generational wealth. They built your father's generational wealth or yesterday's generational wealth, and so you need to find new horses to ride for the foreseeable future.
Austin, if I could jump in on this one, just with the thought, I think this is a great slide to show how over a longer period of time, in this case, almost 35 years, I mean, the entire list has changed, right? But just so folks aren't potentially thinking, well, if I can invest in the largest companies and as long as they're the biggest for 10 or 20 years, I'll be fine. I think that's correct if that's how it works out. But it certainly doesn't take decades for a list like this to be disrupted. And an example that comes to mind is if we were to look at this back, say around 2019, you'd have seen multiple companies from China on this list. And just thinking about investor sentiment back then, if you asked them, what is this list going to look like in the future? I think a lot of investors would have told you that there would be more Chinese companies on the list, not fewer, and certainly not zero in just a handful of years later. So at least to my thinking, while I think these are some great companies on this list, and a lot of them I expect will be around for a long, long time, I do think that, you know, it can be changed and look awfully different just in a small amount of time. Would you agree with that?
It's a great point. It's an absolute great point. And I think you also said, hit it nail on the head. We're not necessarily saying these are bad companies to own right now, but they're probably not. They're almost certainly not going to be the companies that are going to make sure you outperform and create generational wealth for the next couple of decades. I guess I have one more slide on this, and it actually goes to that point. It's a different period of time. In the peak of the market, right before the financial crisis of 2007 to 2009, these were the 5 largest companies: Microsoft, Exxon, AT&T, GE, and Citigroup. With the exception of Microsoft, they have all materially underperformed the market, as you can see there. The S&P is up almost 300% since then. Exxon, by virtue of doing a good acquisition with Mobil, is up about 100%. AT&T is down outside of the dividends that you've received. GE and Citigroup are just abysmal returns. So look, Microsoft is the exception. That's an incredible return, even from 2007, but it's an exceptional rule that kind of demonstrates the rule. It's very rare for these big companies to continue to outperform and help you create generational wealth. Nice. So let's go into the meat of that. So, okay, so these are things we don't want to do. What do we actually want to do? That's what everyone's here for. So let's talk about that. This is the heart of it. At the core of every investor's portfolio, you must own world-class businesses. These are businesses with stocks that are capable of compounding their earnings at a very high rate for a very long period of time. That's really the secret. You're trying to identify companies to say, gosh, these businesses will be bigger, better, more profitable a decade from now than they are right now. And when you feel comfortable with that, you should own those businesses. So we took a long, hard look at this and actually looked over the last 30 years. What were those companies that have generated the most wealth, created the most generational wealth for investors? And here's the list. There's some incredible names and returns on this list. Monster Beverage, if you had put $10,000 in Monster Beverage 30 years ago, you'd have over $20 million right now. So that's a small amount of money turning into a huge amount of money. And I think we'd all agree that that is generational wealth there. And so if you string together a couple of those, and you're in great shape. A couple points here. First and foremost, a couple of these companies, we excluded extreme micro cap penny stocks. So those have been excluded where they were a fraction of a penny and they've bounced something off that. But we included everything else. We included also stocks that have gone public since 1993. So that includes NVIDIA and Amazon and Netflix on that list. You know, a couple that aren't on here, and you may wonder, well, where's Alphabet, Google, where's Facebook, Meta? Those came public at very large market caps. So while they're big companies now, they started big companies as a public company. So the three of us and our entire investment team did a lot of research on this, trying to figure out, okay, fine, we need to identify these world-class businesses. How do you do that? What are the attributes that they have in common? Well, the first thing that is, you look at this list, is it's not necessarily any one industry or sector. Sure, we have some software companies, we have some semi companies, but we've got B2B companies, we've got B2C, business to consumer companies. We've got all sorts of and it's an eclectic mix of companies. So, we had to dig deeper as a team. And I'll tell you, this first one really hits home for me. So we kind of came up with 3 overarching things you need to identify in finding these companies. The first is you need to identify companies that embrace secular trends, embrace big secular trends in consumer demand, technology and technological change, or ideally, in some cases, both. So we're going to talk about a couple of these. Let's talk about the best performing stock. And at one point, one point last week, NVIDIA was maybe the best performing stock, but then it came back after its earnings. But the best performing stock over the last 30 years, Monster Beverage, it started its life as Hansen Natural juices and sodas. And it wasn't even the first to innovate on this, but it recognized the energy drink craze. Mario, I know you wake up and pop about 3 or 4 of those Monster energy beverages. But that recognition and the leaning into the energy drink craze has been huge for the business and obviously huge for shareholders. Similarly, Netflix, Reed Hastings hated having to go back to the Blockbuster and give his CDs back or his DVDs back and sometimes pay a late fee. So the first innovation he had, or the first recognition, was that consumer demand piece of it, that people would rather do something else than have to go to the video store. The other piece, though, is embracing technology. He saw that being able to stream something online was going to be huge. On demand, video on demand, and a lot of the other execs thought he was crazy when they started, and look at how Netflix's stock has done versus some of the other major entertainment companies.
One thing a lot about Netflix too, Austin, is that, and I'm probably stealing some of your thunder for the next slide, probably is Netflix's ability to successfully pivot
right
business, right? And I mean, I'm sure you'll remember, I remember getting my DVDs in the mail,
right,
and it was great and all and well, but it wasn't a very lucrative business. And at one point, I think Netflix was trying to sell itself to Blockbuster, and Blockbuster, kind of provided some laughable valuation, and Netflix was hanging by a thread.
Mm-hmm.
And it was their ability to pivot with their business, not necessarily going in a completely different direction, but providing the same product offering, but through a different venue. And that arguably is really the genius of Netflix, right? It's not remain static.
Absolutely. Yeah, that's a huge thunder steal. But no, I'm just kidding. But no, yeah, we'll get to that 100%. I agree with you. It wasn't just that they embraced secular change once; they did it again, and both not only in demand but also technology. So, 100% agree with that. Point 2 is, look, we want to own great business models, incredible business models, businesses that have attractive profit margins. So that's high gross margins, high operating margins, high returns on invested capital. What it means is they can grow their earnings just by investing in their own business. Just by every time you think about Chipotle, every time they open a store, they generate huge businesses we want to own. And then, of course, pricing power. You need to make when your prices get you need to be able to pass for year in and year out. So I wanted to talk about a couple of names from this. First, look, the one on the bottom, that was our exception to the rule, Microsoft. So Microsoft, year in, year out, generates really attractive returns on investment, attractive margins, attractive free cash flow. So let's think about this. Actually, let me level set this. The S&P 500 on average those 500 companies generate a gross margin on average of about 33 to 34%. And then a free cash margin, or what's left after you spend all sorts of expenses and invest in your business. The free cash margin for the average S&P 500 company is about 8 or 9%. Microsoft has averaged over the last few years 70% gross margins and 30% free cash margins. Just an incredible business, and they continue to innovate and change and make their business better the way Mario was talking about. So we can talk about them a little bit later. NVIDIA, though, look, they are incredible as well. This is a hardware company, first and foremost. They do have software as an add-on, but the most recent quarter, their gross margin was north of 70%, and their free cash margin was north of 40%. Just incredible. We've talked about this, and it's a question that I want us to get into a little bit later, which is valuation question. It's always challenging with high growth businesses, but given that incredible growth that they've seen, NVIDIA is actually cheaper on the basis of its earnings or free cash today after doubling over the last 6 months than it was, last year, because of the growth in the earnings power. So you want to ride those horses that can really grow their business with attractive business models.
One thing I like about NVIDIA, Austin, is, NVIDIA to me strikes me as a company who is not afraid to take a bet, right? And what I mean by that is, 5 years ago, they were building these ultra fast GPUs, mostly for the gaming market.
Right.
And the market's kind of scratched their head and said, that's nice that you're building fast GPUs, but is there really a market? Is the gaming market really that lucrative for you, NVIDIA, to really kind of attack and explore this market? Right. And NVIDIA was right many times over, right? So arguably they were one of the first tech companies to really embrace the gaming generation.
Right. I need some serious horsepower for my Mario Kart against some of my sons who are getting even better. But now you're absolutely right. It went from gaming to crypto and to now cloud computing and artificial intelligence spend. It's been really remarkable to watch. Let's go to the third one. And this actually does go to the point you were raising before, Mario, is that we really want to own well-run businesses. We want to own those companies that are run by talented leaders, that have skin in the game. So we want them to be ethical. We want them to make great decisions. We want them to have skin in the game. That's really going to help us. When our incentives are aligned with these leaders, they tend to do things that are good for the stock. And then, like you were saying, we want them to be able to innovate. The business world and the competitive environment is not static. And it is not, you can't just own US Steel and think you'll be fine, although that's been a pretty good stock lately. You can't be good for 30 years and not think that the world will change. So let's talk about two stocks where this is certainly the case. Amazon, gosh, Jeff Bezos was the wealthiest man in the world on the back of his Amazon stock. He absolutely had skin in the game. And he absolutely has been a perfect example of a guy that's been able to iterate and innovate and adapt over and over again. They went from just selling books on the internet to selling virtually everything on the internet to building brand new businesses, the largest of which is basically inventing the cloud business, where they had such large computing power that they didn't need all the time. And they said, gosh, what if we rent this to other businesses? And then it was an on-demand, really an incredible model that made more economic sense because they could build this cloud computing power at scale versus someone else trying to do it piecemeal. O'Reilly is another quick example. O'Reilly Automotive. This is an auto parts retailer that started their business, pretty humble start, mostly focused on the do-it-yourself home repairman, or someone that repaired their car on their own. Look, over the last 30 years, cars have gotten more complex. Electronic components have increased. The OEMs have done a better job of like sort of making it more difficult to repair your own car. O'Reilly leaned into that. They adapted and actually, rather than shying away from the mechanics, the car mechanics of the world, they embraced that, and their do it for me business with these garages, with these partners, is now larger than the do it yourself business. So these are the kind of companies we're really looking for. I don't know if you guys have any other thoughts there.
Yeah, my thought is that if we polled people ahead of time what the best returning companies are, I'm guessing an automotive parts retailer might not have gotten on the list, but it's a great example of how if you have these attributes, you don't have to be a high flying tech stock to have tremendous performance.
Absolutely. Yeah, no, I agree. So we kind of highlighted some of the ways that their businesses, while from totally different parts of the world, some of the business dynamics were the same, and they had great leaders. So those are some of the things we're looking for. Here's another one. When you can invest early, do it. Because we'll add a column of data to these super massively outperforming companies. And that is what their market cap was either at 1993 or at the time of their IPO. None of these were among the largest companies in the world at the time. And in fact, only one, again, the outlier, Microsoft, had any reasonable size market cap, 20 billion. Even Apple back then was just a $3 billion company. And, put that in perspective, it's over a 3 trillion, or it bounces around the $3 trillion market cap, or 1,000 times larger than it was back in 1993. So it really pays to invest in these businesses before the rest of Wall Street knows how great they are. Now, this begs the question, okay, can you invest early? What else? Well, listen, try to stay invested. As long as the thesis holds, you need to stay invested. There's so many reasons to sell, but and listen, we're going to talk a little bit more about portfolio management and risk management, and there are things that you need to do. You can't have one stock be 100% of your portfolio. But as long as the thesis still holds, don't get shaken out of a great business. There's over 50 times that the world's best returning stocks have had a 40% drawdown or more over the last 3 decades, over 50 times. And most of those times were macroeconomic related, not related to the individual story or the individual company. So you got to have diamond hands, as some people say. If you believe in the business, the valuation is still reasonable, or close to reasonable, and it's still a great business. Nothing has changed there. Hang on to at least a part of that investment. What do you guys think about that one?
I think that's right. I think so. Something that was unsaid but worth highlighting is that this is where knowing what you own comes into, and really having high conviction. Because if you're just buying a stock because, I don't know, somebody mentioned it to you, or Kramer shouted to buy it on TV or something, or you just bought it because it's been doing well the last month, and then it drops 20-30%, there's a good chance you're not going to want to own the thing. Oh, it's not working, I'm going to move on. If you really understand what you own and you believe in it, and like you said, the thesis hasn't changed, ideally you're in a position where if the stock's down like that, you're thinking of, can I add some more, and not getting shaken out.
Right. I think that's a great point, Michael. And I think the flip side is true too. If you don't know what you own and it goes up 20% and you're not really invested into, okay, is that because the story's gotten a lot better? I actually reported even better earnings. Then you may sell in that case as well. So it really pays to know what you own.
The other thing I find interesting about this list too, Austin, is that, it's not like we're looking at a list of 10 companies that are, black boxes or unheard of, right? At least a handful of these companies on this list, I've probably, bought something from them. And I'm sure most of the people on this webinar have bought something from these companies repeatedly, right, over the last number of years, whether it's through Apple, whether it's through Amazon, Netflix, Microsoft. I mean, these are all Intuit, TurboTax. I mean, it's funny, like, Peter Lynch, the old portfolio manager from Fidelity's Magellan Fund, had this very kind of simple mantra, right? Which he said, look, I buy things that I'm familiar with, that I know. And it's kind of similar to Buffett as well. And so, in hindsight, it probably seems obvious that a lot of these companies are on this list. But, I think as we look out to the next, 5, 10, 15, 20 years, I think we're going to find ourselves, looking at companies that we'll probably be using, at least very frequently in our lives.
No, that's a great point. And I mean, look, you just this weekend bought your shocks and struts for that not exactly street legal Stingray Corvette you were working on from O'Reilly. So it comes full circle, 100%. All right, good. Let's keep going. So we found a great a list of names. So we've identified some great stocks, but that's table stakes. That just gets you going. That's the good ingredients. How do you put it all together? The first part of it is your portfolio must be built with your goals, your investment goals, your risk tolerance, your time horizon in mind. We love to say, and if you've seen us talk before, everyone should be goal oriented with their investing, because everyone has some combination of really, when you boil it down, just 3 investment goals. They want capital appreciation, or to get wealthy. They want capital preservation, to stay wealthy, or they want to generate sturdy current income. And so we at SAM have built our investment strategies along those goals. We're here to talk mostly about the capital appreciation piece of that, and specifically our venture growth strategy. But that might just be part of what you want to do. We have a lot of clients that for a part of their portfolio, they like to have that capital appreciation. But they also have a slug that they're like, no, I'm really more focused on keeping this safe and sleeping well at night. So we have our flagship strategy is actually the all weather that could be, or you can have some balance of that. We have some strategies that balance these different goals. So we can talk more about that. Just quickly on risk tolerance and time horizon, the lower your risk tolerance, the shorter your time horizon, that will dictate how you invest. You may say, gosh, I absolutely want to triple my money, but I don't want to take any risks, and I can only invest for the next 6 months. We're not going to be able to invest the same way that someone that is willing to stomach a little volatility and is thinking not in terms of months or years, but even decades would be invested, because the ability to do that over the long term is much different.
I think it's a great point, Austin. I know, one of the benefits for new clients when they come over to SAM is that they're immediately paired with a relationship manager who intimately understands the client's appetite profile and ability profile, right? Because sometimes they may not align with each other, right? Like you said, sometimes you may have a new client whose appetite is much riskier than what their current situation would allow, right? Or vice versa. Sometimes you've got somebody who has the optionality to be more aggressive, yet is very timid about taking more risk. So I think one of the great benefits of joining SAM is being paired with a relationship manager who helps that client kind of discover and understand their ability to invest versus their appetite for investing.
No, that's a great point. And Mario, you're one of those MVP. We wear 2 hats, and so for some of our high net worth and ultra high net worth clients, you have a couple of those, and so yeah, it's really helpful get that perspective from folks. And it's of great value to, we always say that the investing process starts and ends with the client. It starts with them because we have to understand kind of where they want to go. And then it ends with them because we're not done until they get to where they want to go. So it's all about the client, and really these things you're talking about are mission critical for how we will invest and help them achieve investment success. Okay, so we've got some great investment ideas and companies we've identified. We're making sure that we're goal oriented with the right risk level for our tolerance and our time horizon. But that's, again, there's another piece that you need to put together to get it all put together, and that's what we call complete portfolio management. Just putting all the tools together. And these are just three of the things that we like to talk about. One is position sizing. Mario, we talked about a recent client who had a new client for us who had 700 positions when they came over. And look, they've been active in the markets for a long time. And so when they find a good idea, they add to their portfolio and they keep adding and adding. But the problem is when you have that many positions, if any one of them doubled, it barely has an effect on your portfolio. So there is such a thing as over diversification. And then the flip side is, we've had someone where 70% of their portfolio is in one stock, and that won't work as well. That's improper diversification. So we really like to help folks with that. Speaking of that, there are different types of risk management. Obviously, position sizing is one of them. We want to make sure we're not out over our skis, or our clients are, in any one industry, in any one macroeconomic risk. And so we call it risk factors. So it's not just industry risk, but it's also risk factors to make sure there's no one, if inflation were to crater, that might be good for some companies, but it would be bad for other companies. So we want to make sure that we're positioned where a lot of different types of risk factors are managed within the portfolio. And then the last one I have here is tactical asset allocation. I don't know if maybe I'll ask both of you guys to talk about, an example of how we're tactical with our asset allocation. Investing is seasonal. You don't have to be invested in every asset all the time. So I don't know.
Yeah, I can kick that off, Mario, if you don't mind. One example that comes to my mind, even though we're talking about growthier strategies for the most part tonight, I co-manage our income strategy. And something we did in that strategy heading into 2022 is that we didn't own any bonds heading into the year, and we didn't own bonds for almost the entire year, which is really saying something for an income portfolio. I mean, bonds are pretty much a stalwart in most income strategies, but we anticipated that rates were going to rise, and the simple bond math is rates go up, bond prices go down. So we were patient. We waited until we could get much more attractive yields for our clients. So one example of just, we aren't going to invest in things just because everybody else is, or it's, usually traditionally a good fit. We're going to be a lot more mindful about what the environment looks like before we invest.
Perfect.
That's a great example, Michael. The other one I would add is probably, going back a few more years, is what transpired during our through our all-weather portfolio, our flagship strategy in March of 2020. That's our capital preservation defensive portfolio that has a very flexible mandate. And in February of 2020, we felt, given what was going on in China, to start increasing cash substantially. And that's what we did. We went to about 57% cash in that strategy in February 2020, before the market fell out of bed in March of 2020. And what that really allowed us to do is not only avoid a huge part of that downside. I think we only endured about less than a third of the downside, but more importantly, it allowed us to be really opportunistic in the subsequent 3 to 4 months and buy stocks at multi-decade lows. So that's another way of being tactical. And the last thing I'll add is that, one of the things that we like to do with the all-weather strategy is think about adding investments that have low correlation to the markets, right? Adding investments that have idiosyncratic risk. In other words, investments that are really tied to a specific outcome in a particular position or company, as opposed to being influenced by the broader markets. And that investment sleeve that I'm talking about is in merger arbitrage, and we do a good portion of that in all weather as well as in income. We can have a separate webinar about merger arbitrage later, but again, it's just another example of how we try to be as tactical as possible across our strategies.
I think those are super helpful, and I guess this is the key here, is that for the core of your portfolio, we want you to own these world-class assets, but that doesn't mean that around the core you shouldn't be thinking proactively and tactically. So there are times that we're going to want to own more cash, even though we said don't own all cash. There's times that we're going to want to own bonds, even though we didn't own bonds coming into 2022. There are times that we want to have those less correlated portfolio positions, like Mario's talking about, like merger arbitrage, where the stock, our investment goes up or down based on whether the deal is going to close, not on based on whether the market goes up, the rest of the market goes up or down. So that's really the way we're playing it. But that core is really what we're talking about today. So why don't we close by just thinking about a couple of really world-class ideas within the venture growth portfolio. So look, I guess I said, I have one last thing here. Look, clients have entrusted us with their capital to do just this: pick great stocks, put it all together, and we'd be happy to do that for you as well. So with that, I thought maybe we'd talk a little bit about Sam. We haven't really talked about Sam in this webinar. I know we have some friends or longtime followers of Sam on the webinar, but some folks are probably new to us. So who are we and why are we different? Look, this in 6 bullet points is why we think we're different, and it's our commitment to you and our clients. First and foremost, we are a registered investment advisor and not a broker dealer. That means that we're a fiduciary. We have a standard that's high. That is, we are seeking to make investments that are in your best interest. Broker dealers have a different standard. It could be, is this suitable for you? That you want to be with a fiduciary. You want to be with a registered investment advisor. We follow the golden rule and we eat our own cooking. So what does a golden rule mean for us? Well, Mario and Michael and I and the rest of the team at Sam are trying to build an investment organization that we would want to use if the roles were reversed. What does that mean? That it means these things. It means that we're providing skilled investment management, broad financial planning. So you can think more than just about how my stocks are doing. You can think about how does that fit into your entire financial future and picture. We want to have great client service. We want to have great and then complete transparency about what we're doing and talk to you and you can know and see what we're doing and you have access to all of your accounts, et cetera. But it goes beyond just the golden rule. We actually do eat our own cooking. We have accounts that pay full fees that sit right alongside you. So today's talk is about venture growth. Venture growth is my largest investment among the strategies that invested in, and I'm excited about it. I think that I'm looking to generate long-term capital appreciation and think that the venture growth strategy will continue to do that like it has this year. It's materially outperformed the market and its benchmark. We provide informed active management. Michael hit on this earlier, but it's just a strong belief of ours, and it's a belief rooted in the data that when you make informed decisions, you'll make better decisions. So We want to know what we own and why. And we think, back to the golden rule, we think you should want to know that. If you think back to when there was a run on Silicon Valley Bank and some other banks, and the sector got scared, you should be able to call your investment advisor and ask them, number one, do we own any banks? And if we do, why? If you called us, 8 of the 9 strategies, we would have said, no, we don't own any banks. And in our income strategy, we did own 2. We sold 1. We still hold the other, and we could tell you why we held on to that and why we're excited to continue to hold that one.
Austin, one thing I'll add about the informed active management bullet point is that I'm always surprised when I speak to a new client who's coming over to Sam, and they ask me to kind of take a look at their old or their incoming portfolio from whatever manager they're with. And it really perplexes me that almost all the time, these outside managers are just invested in ETFs or mutual funds. Or sometimes you'll see a structured note in there, which is a huge head scratcher, right? And just want to reiterate that those types of passive or opaque investments is not what we do here at SAM.
Great point. Very good. I'll rip through the last couple of these, but not because they're important, not because they're not important, because I realize that I'm going long in some of my explanations. Look, we're reliable. Rely on us to do what we say we're going to do, and importantly, to do right by you, our clients. I know there's some folks on the call today that aren't that familiar with Stansberry Research, and there's some that love Stansberry Research. That's okay. You know, we utilize and optimize Stansberry Research, and we use it as one of the many tools that we have in our quiver, arrow in our quiver, to produce what we think is that really good informed investment management. So we think we do a good job of that, and that's a great tool that we have at our disposal. And finally, again, we value your input. This business starts and ends with you and what you want to achieve, and it's our North Star to help you achieve it. So maybe that's obvious, but also equally as important to point out is when we have a sense for what you want, we can get there in a better way and a more informed way. So in summary, the way to build generational wealth, don't do these things. Do not hide out in all cash. Gold is great. It does serve a purpose as a store of value, but do not own only gold. And please, when you're owning productive assets, do not own only the world's largest companies. We think some of those are very good companies right now. Microsoft may continue to be that exception, but don't only do that. You should do these 4 things instead. Own world-class businesses at the core of your portfolio. Invest in them early. And as long as the thesis is intact, stay invested. You know, you need to have a portfolio that's built on your goals, that's for you. And then finally, put it all together with some of those complete portfolio management tools that we talked about: asset allocation, position sizing, risk management. Do that on your own, or Sam is happy to do it for you. So
Thank you guys, and have a good one.
fantastic. Thanks, everyone. Take care.
Thank you.
Take care.
Thank you.